What in the world is volatility? Volatility is the magnitude of the change, okay? So this is not very volatile compared to this. That has a higher volatility than this. It's the magnitude, or kind of the range of the change, okay? So the difference, as you can see, is much greater. That's what volatility is. And it doesn't mean direction. It doesn't mean that it's going up. It doesn't mean that it's going down. All it means is the change of ups and downs relating to stock prices, option prices, the market itself, ETFs, anything. It just basically means the magnitude of change. So what's important about volatility that you got to know when you're trading stocks? Well, basically, the more volatile the market is, the crazier it gets. So if you have a really high volatility and it's just going up and down, plus 200 points and then a negative 300 points, that's a 500 point shift in the market. It's important to know this and understand this because trends are a lot harder to spot when you're more volatile, because stock prices do all kinds of crazy stuff, and what that means is people are crazy out there. So when it's shifting all this up and down, you have to be really careful. Swing trading is probably more risky, so you want to be careful on those. So meaning if you're holding for multiple days on end, you don't just see patterns like this. It's going to be kind of like that, and you don't know what's going to happen. You could see your account jump $2,000, $3,000. You could have it decline $2,000, $3,000, all within a blink of an eye. So when you're doing high volatility days or high volatility months, it's probably better to stick to day trading, meaning you buy it in the morning, you sell it towards the evening, or hold it for just a fraction of an hour, 15 minutes, 30 minutes, but you're basically limiting your upside, but you're also limiting your risk, because high volatility days are a disaster. You're setting yourself up for a heart attack if you're not controlling your money properly. Now, on the other hand, if you're a long-term investor and you're holding it for 10, 15 years, that's fine and great. I guess you could hold it through. But in reality is that high volatility days is something to watch out for and take note and understand that you want to lower your risk on those days. So when you do have those high volatility days, what can you trade, or what can you do if you need to actually make consistent money day-to-day, living expenses and so on? Well, inverse ETFs are great. You can trade off of a 3-minute or a 5-minute chart, and that would be a day trading chart. So you would go off of like something like a BGZ, SKF, TZA, and FAZ. There's tons of inverse ETFs, and what that means is an inverse ETF is opposite of what the market's doing. So if the market is kind of having those crazy days, or they're going down 200-300 points, these will actually go up because they're bearish. They're bearish ETFs. They're inverse ETFs. They do opposite of the market. So these are just a few. There's a lot more out there. So look them up. You can look them up online and find other inverse ETFs. But when you have those crazy volatility days, these are just something that you can trade. They're a little bit more stable than just one specific stock because they're ETFs, which is a group of stocks. And they're a lot better, but note that this would be basically only for day trading purposes. It could be for 10 minutes, it could be for 20 minutes, could be for an hour. Hold it until it stops running and then get rid of it. I wouldn't hold it overnight or anything like that.